All right, welcome to Chapter 9, Accounting for Receivables. Up to this point, we have been focusing on a lot of the kind of generalities, the big picture stuff, following the transactions through to the closing journal entries and the post-closing trial balance. Then we did merchandising companies and talked about them, talked about inventory, and we suffered through the accounting information systems. And then we have talked about bank reconciliations and stuff. And as you can see from the cash standpoint, bank reconciliations, we're now talking about accounting for receivables. We're starting with Chapter 8 and now 9. We're really just targeting certain areas. We're going to be focusing solely in certain areas of the accounting process and accounts that are in each of them, like assets and what have you. We're going to be talking in Chapter 11 about some current liabilities. And then in Accounting 112, we're going to start dealing with other things like fixed assets, accounting for partnerships, accounting for corporations, stocks, and other things like that. So it's really, that's why I tell you chapters 1 through 4 and even in 5 were very important, okay, to build that foundation, because now we're going to be talking solely in this chapter about accounts receivable. So with that, here are your learning objectives. You can pause here and read these. Bottom line is we're going to be talking about there are 2 methods that we're going to be authorized, but we'll go through each one of them. There's another one that, while it's common, it's not authorized through GAAP. All right, so basically a receivable is something that is due to someone else, owed to someone because they've provided some kind of service or whatever. In this situation, you can see here Nike has a whole lot of receivables that are due from another company, as opposed to comparing Tesla, Intel, and Microsoft. Company needs to make sure that they're tracking each of their customers and knowing exactly who owes them what and why and how much. When we have a credit sale, this is kind of a reminder here. We see that when we have a credit sale, we're going to debit our account receivable because it is an asset. And we're going to credit our sales. And then when we collect on that account, we're going to debit our cash and credit our accounts receivable. This is just showing you the same transactions based on the ledgers from the accounting chapter 7 that we did. That kind of shows you that. We also can do sales using credit cards, and what this does is that it allows us to make sales without having to evaluate somebody's credit worthiness. So in this situation, we make a sale. We're basically, when we make $100 sales, we're saying we only really made 96 because of that $4 or 4% fee for using credit cards. But it's one of the things where you have to really evaluate, is using credit cards important enough for us and cost efficient enough for us to use because of this fee, 4%. See, you remember in bank reconciliations, they gave us on our bank deposits, they gave us like a 0.4% interest on it. But just on a transaction, one transaction, it's 4%. These banks, I tell you what, if I could do it all over again, I would start a bank up. And they make money just out of thin freaking air. Anyway, enough of that. So anyway, we're going to record the I kind of fundamentally disagree with this because I don't agree with it. If you sold $100 worth of inventory, well, I guess it's not $100 worth of inventory, it's cash. I still don't like it, but I get what they're doing here. It's fine. So basically, we're trying to show you what happens when you just have a cash sale. Is basically what we're trying to show you. You can either do cash, you can do credit cards. If you do credit cards, you're going to net out the credit card expenses. This is basically what they're trying to say. I think that's not quite. I don't like it. I just don't like it. I think showing more of the transactions better, showing that you sold it, and then having that percentage of sale as a separate transaction as a part of that is fine. But I guess I wouldn't know how to do that other than the way they did. All right. So sometimes we have customers that don't pay. And this is where the crutch of this is what I really want to get into. Is we have to write it off. If they're not going to pay us, let's say the company just went bankrupt. I mean, we know we're never going to get the money from them. Maybe you have a brother or sister or cousin or someone you loan money to, and you're like, I'm never going to see that money again. My wife tells me if you ever loan money out, just pretend like you're giving it to them, and if they give it back to you, then bonus. But if not, you're never just plan you're never going to see it again. So if that's the case, we have two methods of writing off these bad debts: the direct write-off method and the allowance method. Only the allowance method is approved by GAAP, but I'm going to show you the direct write-off method, but I'm not going to spend a whole lot of time on it because I'm never going. Listen, any question is asked of you, any problem given to you, if one of the options is bad debts expense, unless the question states, which it won't, unless the question states which one of these will you never use, it will be the correct answer is the direct write-off method. Otherwise, given the option of the direct write-off method, you can immediately rule that one out as the correct method. It is never going to be one we are going to use. But you need to learn it and you need to know it because any company that doesn't require an audit or that is in the cash basis of accounting, they use the direct write-off method. So you need to be aware that it exists and how to do it. But it's not one that we teach as an accrual accounting class. So here we go. Using the direct write-off method, TechCom determines that on January 23rd that it cannot collect $200 or $520 owed to it by its customer J. Kent. So on January 23rd, we are simply going to debit bad debt expense and credit accounts receivable by $520. It is that simple. That is all we're gonna do. Now, what happens if they decide eventually to pay us? Well, we've already written it off. So they end up paying it to us on March 11th. We have to reinstate it. And the reason for this is we can't show that we got money from nobody for no reason. And if we just show that we got a debit for cash and a credit to accounts receivable of J. Kent, it will show our books as a accounts receivable for J. Kent in the negatives. And so what that basically says is that we owe them $520. So we can't do that. So we have to reinstate this, and then we have to deduct it at that point. Somebody did ask one time, well, why can't I just debit cash and credit bad debt expense? It's doing the same thing, and it doesn't even touch J. Kent. Like, that's exactly right. Because if you do that, that's what we call money laundering. Okay, you can money launder that way when you don't know where the money came from. So this is a way to determine and identify where the money came from. Given any audit or police investigation, you can demonstrate, hey, we got this money from this guy who owed it to us. We wrote it off. We reinstated it. We got it. We credit it. If I see that as an audit, I know you're doing the books the right way, or at least, the direct write-off method the right way. If I see the cash debit credit bad debt expense, my eyebrows is going to go up. I'm going to look deeper. All right. So using the direct write-off method violates the expense recognition principle and likely the materiality constraint. So it says that we could use the direct write-off method if it's basically the results similar to what you would do during the allowance method. But your expense recognition principle is botched because you're not expensing this in the same accounting period that the revenues were created based on this transaction. Basically, if you have a account receivable that's not going to be received, then it should be expensed in the same accounting period that revenue we thought we're going to get would have been recognized. So we can't push that expense forward into another accounting period, which would be likely the case because we don't know if that's going to go bad for usually a couple months after it's been established. And so even if you're doing it on a monthly basis, then it's obviously outside. If it's on a quarterly basis, then it's a good chance it's outside the accounting period. If it's yearly, maybe you have a shot. But if it's, the transaction occurred sometime late in the year, good chance is that write-off would take place in the year later on. So we have to expense our write-off of that account in the accounting period we think that we use to create it. So what we're going to do is we're going to use what's called the allowance method. So what this is we're basically going to estimate how much of these accounts are going to go bad. Now, we don't know for sure. It's an estimate. It's like depreciation expense, okay? We talked briefly about depreciation in chapter 3, but we didn't go into a whole lot of detail about it. It's okay. We're going to go into it in chapter 10 in Accounting 112. But the bottom line is we have this allowance method to where we're going to say, we think around this much percentage of something is going to go bad, okay? Whether that's basing it on sales or basing it on what's owed to us already. There's two different methods within the allowance method. So we're going to determine which one's best for the company and go from there. So in this allowance method, what we can do is we're going to write off the estimate in the accounting period that we think those revenues are going to go bad. And we're going to report what we think we're actually going to collect from our accounts receivable. So we're more precise on our balance sheet and our income statement than we would have been using the direct write-off method. What does that gain? What does that benefit for us? It benefits us because now we're able to present financial statements to our investors and our creditors that are more accurate in what we believe the company is going to look like. Otherwise, we could hide a lot of bad things by not saying, by waiting to write things off until the next accounting period, or write them off sooner, depending on what will benefit the company at that time, getting whatever loan or investments we're looking for. You could hide things a lot better in using the direct write-off method. We don't want to do that. All right, so what we're going to do when we estimate something in this account, the journal entry that we're going to fund the allowance for doubtful accounts, which is a contra asset account to the accounts receivable account, is going to be a debit to the bad debt expense in the period in which we've made those revenues. And we say, okay, we think that $20,000 is going to remain uncollected. We're never going to collect it. We're going to fund the allowance for doubtful accounts. Oh, okay. Yeah, this is getting thrown off here. $20,000. Okay, I'm sorry. All right, I was misreading this. At the end of the first year, $20,000 of credit sales remain uncollected. So we have $20,000 in our accounts receivable. Based on an experience of a similar business or our own experience, either way, it's fine. We think $1,500 of its accounts receivable uncollectible. So we're going to debit our bad debt expense of $1,500 and credit our allowance for doubtful accounts for $1,500. So we're going to have a $1,500 credit on our allowance for doubtful accounts and a debit for our accounts receivable. What this is going to do is it's going to show on our balance sheet that we think we're going to collect $18,500 of this accounts receivable. And that's what we're going to present on our balance sheet. And here it is. Okay, great. So our current assets, we can show the account receivable less the allowance for doubtful accounts, $1,850, or we can just show accounts receivable in parentheses net of $1,500 doubtful accounts, $1,850. Either way, it's fine. Then when we go and write off a debt, we're going to debit the allowance for doubtful accounts by the amount we think is going to be collectible, $520. And then we're going to credit the accounts receivable of the company or person that isn't going to pay us, thus reducing the amount that that person owes us and reducing the balance in our allowance for doubtful accounts. Because sure enough, we thought $1,500 in total were not going to be collected, and now we're starting to not collect, so $520 is going to reduce that balance. Now, what does that do to the balance sheet? Oh, sorry, it took me a second. I'm like, what the heck? Yeah, no, this is exactly what I'm trying to show you, is that before the write-off method, we had a net realizable value of our accounts receivable of $18,500. After the write-off, we still have $18,500 because we've already expensed it. So our accounts receivable is going to go down, but so is our allowance for doubtful accounts by the same amount. Thus, we're not going to be changing what we're showing on our balance sheet. It's still going to show that $18,500. That's why we use this method, because we're basically saying at the date of the balance sheet that $18,500 is what we're going to collect. And then when we write off something, we're just proving ourselves right in the right direction. We're saying, hey, see, we've written some off. We have less than we have now, but we still think we're going to collect this $18,500. Okay, so we're in good shape. We're in good shape. Now, what happens if we recover a bad debt? Well, similar to the direct write-off method, we still have to reinstate it, but instead of reinstating or reducing and getting rid of our bad debt expense, we're simply going to refund our allowance for doubtful accounts by the amount we wrote off. It could be the full amount. It could be just a partial amount. We're only going to apply this to the amount that is given to us as a payment. So in this case, they're going to pay it in full. We're going to debit accounts receivable, reinstate that amount, and then we're going to refund the doubtful allowance for doubtful accounts, and then reflect that he paid, or she, I don't even know who Kent is, Jay Kent, debit cash to receive the cash, and credit the receivable to, again, then remove it off the books as having been paid. So we have two methods, as I said, on doing this estimate. We can either do the sales method or the accounts receivable method. I'm going to be straight with you. The sales method is super easy, and as a result, you'll probably be tested on the accounts receivable method, okay? It's just the way it works, man. Percentage of sales. I mean, you're going to be tested on both of them. It's just that if you had a big problem to do, it's going to be on the percentage of accounts receivable, because I think that one, it's really a good method. I don't know if this slides, these are new slides, if they're going to show the percentage of how many companies use each method. I don't know if that information is even out there, but we're gonna do that one a lot. But the bad debt expense is computed for the percentage of sales method. Is you're just taking the current period sales. Now this isn't really good here. It says current period sales. It should be current period credit sales. Okay, you're not going to take the percentage of bad debt off of cash sales, because they are never going to go bad. Cash sales are never going to go bad because you've already received the cash. So you're only going to do this off of the current period credit sales, multiplied by the bad debt percent we expect to happen, and that's simply our bad debt expense. Super easy. We got $400,000 of credit sales. See, here it corrects itself. It says credit sales. Okay, that's what we're looking for. They could have had another $200,000 of actual cash sales for a total of $600,000 in revenue. Okay, but we're only looking at credit sales. I'm keep emphasizing that because I want to make sure you guys know we're only dealing with this accounts receivable method. We're only dealing with credit sales. Cash sales, we're happy. We prefer cash sales. It's easier to do that. 0.6%. This is 0.6%, okay? Not 6%, and certainly not 60%. So we're going to take this 400,000 and we're going to multiply it using a calculator. We want to use, and let me pull up my calculator. It's kind of been closed. $400,000. We're going to take this decimal version, okay? And we're going to multiply it. Now, we could do 0.6 and then click the percent. But look what it did. It just moved the decimal over twice. That's what you can do. When you see 0.6, you can click 0.006. It's the same thing. And then hit enter. So we're going to write off as an expense that we think are going to go to bad debts of $2,400. So we're going to debit our bad debt expense, $2,400, and credit the allowance for doubtful account for $2,400 as well. Going back to this one, our accounts receivable account, remember, is going to reflect on our balance sheet as 400,000 minus 2,400. So we're going to show as a net accounts receivable on the balance sheet of 397,600. And if somebody writes off $400 because we don't collect it, we're going to reduce the accounts receivable by $400 from the 400,000 that's owed to us, and we're going to reduce that $400 off of the 2,400 we funded to the allowance for doubtful accounts. And so those numbers themselves will be different, but this 397,600 will remain the same after the write-off. Again, I'm just reminding you from what our exercise was on that last one. Now, what do we do when we do the percentage of receivables method? This method's a little bit different because we have to calculate what our bad debt account should be at using the percentage. So let me explain. When we have an allowance for doubtful accounts sitting here, we have all of this information here. We have $50,000 in accounts receivable and a $200 credit balance in allowance for doubtful accounts. We think 5% of our accounts receivable will go bad. So what we're going to do is we're going to take that $50,000 and we're going to multiply it by 5%. And that's going to give us our ending balance here. But we already had a credit balance of 200. So to go from a credit balance of 200 to 2,500, we need a credit journal entry of 2,300. So we're going to debit our bad debt expense for 2,300, and we're going to credit our allowance for doubtful accounts for 2,300. So it's a little different. Whereas before, the percentage of sales method, you calculated this number and you just added it together to get the ending balance. This method, the percentage of accounts receivable method, you're calculating the end balance, and you need to find out what adjustment you need to make to get wherever your allowance for doubtful account balance is to the ending balance in the account. So you're going to make an adjustment. Now, you could have a credit balance and you could have a debit balance in the allowance for doubtful accounts. It's one of those rare accounts It doesn't really follow all of the rules. Okay, you can have a debit or a credit balance in the allowance for doubtful accounts. And in your homework, you're going to see one that does have a debit balance. So you're going to have to, instead of, in this case, you just take 2,500 minus 200 to get your amount. You're going to be on this side of the number line, and you're going to have to add those two numbers to get to the adjusting number. Don't worry about it and don't stress about it right now. If you need to listen to this a little bit more a couple times, go for it, okay? But in the homework, you're going to see, if you watch my video for the homework help, you're going to see how we do that, and it's gonna hopefully open your eyes at that point. If you struggle after that, then I want you to let me know, okay? And we'll work together and get you there. All right, so the next one is going to be the aging of accounts receivable method, but I'm going to pull a cute one on you because I get the sense sometimes that some of my students near the end of the semester start to smell that nice end of the semester happiness and forget to watch a video. And so all they're going to do is go to the end of my videos and just get the word and plug it in and do it. So here, this is going to verify because I know that I'm going to have at least one student every semester who's going to say, Brian, you forgot your word in the accounts receivable or chapter 9 video, and I'm going to be like, gotcha, because it's in there, it's just not at the end. So your word for this video, and I don't encourage you to stop watching this video now that you're getting the word, mind you. Please continue to watch it. But the word is receivable. The word is receivable. Receivable. And for those of you military or police types, it is Romeo, Echo, Charlie, Echo, India, Victor, Alpha, Bravo, Lima, Echo. I forgot what the V was for a second there. It's Victor. Receivable, receivable. Okay, that's your word for this video. All right, so the last method that I'm going to show you is the aging of receivables method. It's pretty fun to do. Actually, I really enjoy doing this one. It's a lot of it's just a lot of calculating, a lot of percentages and stuff like that. And this is what it looks like. You have each of your customers, how much they're owed. Some of them are not due yet. Remember, credit terms are 210 net 30. It's due in 30 days. So we're looking at it in that sense. It's not due. How much of the stuff that's currently in our not due yet do we think probably is going to go uncollectible? 2% is kind of something we've seen in the past. So we're going to take all of our not due yet, add it up, multiply by 2%. This is going to be what we're going to put into our estimated uncollectible. And we're going to do that for each grouping of it. Sometimes people have stuff going into 180 days, 360. I mean, it just depends on the nature of the business and what they're doing. But that's basically how we're going to do that. And then again, we are calculating the ending balance with this 2270 again. And so we need to find out what our adjustment's going to be. Come over here and look at this T account. Probably a better example here. You had an unadjusted balance of 200, and then you calculated on that previous page the estimated balance we need. And so we're going to say, okay, well, we need $200 less to get us up to this credit balance of $2,270. And so we're going to go $2,070 is our bad debt expense, and so that'll and we're going to fund our allowance for doubtful accounts at $2,070 to get us up to the estimated balance we need to be at. Okay, what happens when you have a debit balance? And this is good for this. We're doing it on the aging of the accounts receivable. This is good for the percentage of accounts receivable method as well. All right, so we have, what if we had a $500 balance here? Well, when we calculated our $2,270 balance, we need to go from the debit side all the way through to zero, and then from zero to the 2,270 credit side. So we're going to add the ending balance we need to the debit balance we had to get our required adjustment. So on a debit balance of 500, we're going to need to make an adjusting entry of $2,770 to our allowance account as a credit to get us to the credit balance of 2,270. Right? I hope you understand this method and this what goes on there. If you have any questions, again, I hope you'll let me know. We definitely need to figure that out. Here's a good little chart to kind of show you this. I usually draw this on the board in class to kind of help everybody understand how this works. Yeah. I'm just looking at it and reading it for a second there. Let you do it too. Okay, so let's look at our ratios here again. We just kind of want to look at this. Oh wait, no, this is promissory note stuff. You need to know this stuff. So a lot of times, what happens with notes receivable, it's basically they're promising to pay us at a future date with a percentage, usually very short term, 2, 3 months maybe. Um, computing your maturity date, you're taking, let's see here, on July 10th, TechCom received a $1,000 90-day 12% promissory note as a result of a sale to Julia Brown. Um, Basically, all we're going to be doing is taking the total number of days here. It's a 90-day note, and calculating the total number of days and doing the percentage in the notes we're receiving, the interest that we're receiving on this that we're going to owe. So we received this. Oh, that Julia's going to owe us. Sorry. So basically, you calculate the total number of days, um, and get that going. And to calculate the percentage, you're going to take that. It's that 12% is an annual rate. So you're going to take that 12%. You're gonna divide that by the total number. In this case, it's a 3 month. You can basically say 3 months, or you can calculate the 90 days if you want. 90 over. We do 90 over 360 if you do it the days. I would do it just 3 divided by 12 myself, or what is that, 1/4? And so that would be 3% of $1,000 is the interest that you would receive on that note. Oh, and here we're going to do it. So yeah, time is the fraction. We use 360. So we are going to take the 90 over 360. So it's $30 is what we're going to get on interest on that note. And to record that, we're going to record the notes receivable as a debit for 1,000 and a credit for sales. This is in lieu of an accounts receivable. If they're going to give us a note that we're going to pay in 90 days, because normally our terms are 210 at 30 kind of stuff. This is longer than that. So they're like, hey, we're not only going to just pay you, we're going to give you interest on it as well. That's what we're doing here. And then we're going to record the receipt of the note when they pay us the money that we get, as well as interest when received. Oh, this is if they didn't, yeah, if they didn't give us the full amount, yeah. So we're going to write off some of it as well. Cash debit notes receivable. Well, that's if they didn't pay us and we got the note. I apologize. Sometimes trying to read this fast, I want to make sure I get it to you. So record the honoring and dishonoring of a note and adjustments for interest. Okay, I'm not going to go into a whole lot on this. Just bottom line is, if you get the note, you get the money. You're going to debit your cash that you got, credit the notes receivable because you got it paid. They paid it off, and you're going to credit interest revenue. But if they don't pay it off, oh, you're moving it to an accounts receivable, basically. That's what happens when you dishonor notes. Sorry, it just took me a second to realize what they're doing. Again, this is if your note extends beyond the due date, excuse me, the due date of the note extends beyond the end of the year. You have to account for the amount of interest you've accrued at the end of your accounting period. So you're going to take $15, record that in the accounting period, and then record the rest in the later months as they accrues. And then here's your adjustment. No big deal. Just kind of know that that exists. We're not going to get into factoring. I'm not going to do that, and I'm not doing I'm not going to do the asset receivable turnover. So let's just go. That's it for the end of chapter 9. You guys have a good one. We will see you guys in the future chapters, and I wish you guys the best of luck. And we're almost done with the semester, so we'll see you in chapter 11.